Good morning. In this session, we'll discuss about warranty liabilities. Before we go for warranty liabilities, you would have purchased products or you would have purchased certain bikes, cars, two-wheelers and so on. Of course, bike is part of two-wheeler. Okay, or a machine for your company. Okay, where the product manufacturer would have given a warranty. Normally for mobile phones, they tell that 1 year warranty. Okay, within that 1 year if something happens, they will repair the product or replace the parts, all those things. So this particular warranty the price includes that warranty. Price includes that warranty. For example, you purchase a mobile phone for 25,000. Okay, so that price includes this particular warranty. They don't charge extra for that particular warranty. Okay, for these types of warranty, no charges are made extra. So this is part of product cost. Okay, this is first type. Okay, second type warranty is an extended warranty. Maybe you can see at the time of buying a product in online, add extended warranty for 2 years. Normally 1 year warranty is given. Add extended warranty for 2 years for this machine or for this mobile or for this gadget, like that you would have seen. That is sold separately. Extended warranty is sold separately. Okay, so assurance type warranty is part of product that is sale. It is part of the price. Service type warranty is a kind of an extended warranty that is sold separately and price or revenue is collected separately. Okay, so how to account for it, we are going to discuss. How to account for it, we are going to discuss, and how to recognize revenue also we are going to discuss. Okay. Yeah, warranty results in an obligation. For example, if there is a mobile or if there is a gadget that is sold by you is coming for repair or replacement, you have to spend money. So it definitely results in a liability. But whether the product will get damaged or whether the product will malfunction during the warranty period, will it come for service, is a question mark. Okay, definitely there is going to be some expense, but what is that expense? What is that liability? It's very difficult to identify. So maybe based on the past experience, that can be assessed. Okay, warranties are assessed and recorded as liability. Okay, and sometimes, as per law also, that obligation is created. Okay, so there are so many factors. One is the legal factors, second is the warranty period, then the tasks and the obligations which the company promises to perform. So many factors are there in determining that particular warranty liability. Okay, so that's what I said. We have to reasonably estimate. Okay, it cannot be a contingency. It cannot be a contingency. Okay, this can be reasonably estimated. Okay, suppose you sold a product. If the warranty is going to extend to the next accounting period, a current liability, an obligation has to be created. Okay, then suppose if the warranty is extended for 2 years or more, within 1 year, next accounting year, it can be taken as current liability. If it is beyond 1 year, then that should be classified as non-current liability. That should be classified as which one? Non-current liability. Okay, what is the journal entry we have to pass? Okay, assurance type warranty expenses account debit, because that should be debited. Expenses should be debited. So how to calculate this? This can be calculated as a percentage of sales. This can be calculated as a percentage of sales. This can be calculated as a percentage of cost per unit. There are so many methods. Okay, it's all based on the past experience of the company. It all depends on the past experience of the company. Okay. So we are not spending this immediately. It's just a kind of a provision that we create. Warranty expense account or to warranty liability account. It is just a kind of a provision that we create for the warranty liability. Okay. So how to create this? It's based on the percentages. It's based on the estimates. For example, a company sold products to the extent of $20 million. Okay, they are expecting that there may be a liability. In the past, around 4% of the products come defective. So estimated expense that should be provided will be, okay, 20 million into 4%. So this is the expense that you will provide. What is the what is the journal entry you will write? Warranty expenses account data to warranty liability account, because as of now it is only an expense. It's only an expense that we recognize based on the percentage. Okay, so this will be recognized. Subsequently, when you incur expenses for this, warranty liability account data, it can be to cash or it can be to stores, the raw materials or spares or etc. is used, or to labor cost, or for example wages cost. Okay, if employees are used for this. Okay, so whenever the liability is incurred, at the time this particular journal entry is passed. So this may be 8 lakhs or this may be 7,50,000. Okay, the actual expenses may be lesser or more, but based on the actual expenses, the liabilities are being met. So the first one is like a provisioning. Okay, warranty expenses account data. This will be charged in profit and loss account, that is income statement. The provision that is created for warranty expenses is recognized in income statement. On the subsequent incurring of that particular expense, we are just passing a journal entry for the payment. So this will only affect the income statement. Actual payment will not affect the income statement. That's what. Warranty expenses account data to warranty liability. When you are paying the expense, warranty liability account data to cash, inventory, or the appropriate the cost that is being adjusted with. Okay. So expenses, as I said it can be as a percentage of sales, okay, or as a percentage of cost of output or cost of the product. Okay. Liability is nothing but amount payable. Look at this example. Warranty costs are estimated at 4% of sales. During 2019, stereo system sales totaled 3 million. Actual expenses are 67,500. In the income statement for the year, they should report a warranty expense of, expenses are based on the estimates, 4% of the 3 million sales. 4% of 30 lakhs would be $1,20,000. $1,20,000. This actual amount spent, or the journal entry will be like warranty expenses account data to warranty liability 1,20,000. Actual expenses when you are spending, warranty liability account data to cash. Okay, actual expenses doesn't matter. In the profit and loss account, whatever is estimated, that is recognized in income statement or profit and loss account. Okay. As I have told you already, for balance sheet purpose, if the warranty is extending for only for the next accounting period, it should be recognized as a current liability. If it is going to be for more than 1 year, it is going to be recognized as a non-current liability. Okay. So this is about assurance type warranty. Next one is service type warranty. I told you already, it's a kind of an extended warranty, and it is sold separately, which means you will be collecting the money. from the customer for this particular warranty. So first you record the journal entry for collecting the money. Okay, how to pass the journal entry? Cash account data R2, service life warranty liability account. Okay, don't take it as income. When you collect extra money, okay, don't take it as income. Okay, for example, a customer has purchased a product, or total sales for the last year is, let us assume the same example, okay, 20 million. Okay, we have given extended warranty, okay, for all the customers, but customers purchased to the extent of, let's assume, $2 million. Extended the warranty purchase was only to the extent of 2 million. So they would have paid cash for this. Cash account data 2 million to warranty liability account, service warranty liability account $2 million. Don't take it to P&L account. This is not your income, because let us assume this extended warranty is collected for 2 years period, 3 years period. During that period, if there is any expense coming, we have to adjust with this particular cash that is received. So whatever is received is recorded as service warranty liability. It is not recorded as income. Okay, don't take this to income statement, because you have got obligation to take care of the expenses. You have got the obligation to pay the cash whenever that expense has to be incurred. Okay. You can go through this example for a better understanding. Just read through the example. Okay, you will understand by yourself. The sales is $5,000. Service type warranty collected is $200. So whenever you are collecting the cash account data are 5,200. The income to be recorded is only 5,000, and the 200 has to be recorded. 200 has to be recorded as a separate line item. So whenever the expenses are incurred, okay, then that will be adjusted. Warranty liability to inventory that is used. Accrued payroll is nothing but wages. This is for the stores used. This is for the wages that is incurred for that. This is for assurance type warranty. Okay. So for assurance type warranty, whenever the expense is incurred or whenever the expenses are estimated, we create a provision, right? Please understand, there are two types of warranty. One is assurance type warranty is included in the product price. Okay. So assurance type warranty expense account data to warranty liability. So this 100 will be recognized in income statement. Subsequently, when you incur that expense, liability account data to whatever is used, inventory or payroll like that, it is going to be recorded. Then whenever service type warranties are incurred, okay, we'll adjust with that particular revenue. So there is a clear understanding. Okay, since sales is recognized in income statement, this 5,000 is going to be recognized in income statement. Okay, that warranty expense also will be recognized in income statement. Which means this sales is credited to the extent of $5,000, and the warranty part of that particular sale package is recognized in income statement. The service type warranty or extended warranty is not taken to income statement, that is kept in a separate account. So whenever the money is spent or whenever the expenses are incurred, and we are going to use this particular 200 and settle that particular money. So this is about accounting for warranty. I will cover the next two areas, that is accounting for taxes and accounting for leases in the next lecture separately. Okay, so let us cover our, because accounting for taxes or accounting for leases is to do with assets as well as liabilities. So let me do it separately. Now let us go with equity transaction. This we had seen in the form of statement of changes in equity. Statement of changes in equity. So what covers in SOCE? Okay, number one, you will have equity, common stock, preferred stock, EPIC, retained earnings, these are the main parts. Common stock is refers to ordinary shares held by members or shareholders. We call it as what? Common stock. Common stock. Okay. Preferred stock. Preferred stock. In India, we call it as preference shares. In India, we call it as preference shares. We will see what is a preference share. This is nothing but excess amount collected than the par value. For example, if the par value, nothing but face value, is $100, if shares are issued at 140, the difference 40 is known as additional paid-in capital. Difference is called as what? Additional paid-in capital. Retained earnings is nothing but undistributed profit. Okay, then there is something called as OCI. We had seen all unrealized gains and losses will be reported in other comprehensive income. Other comprehensive income. Then from this what will be adjusted is treasury stock. Nothing but shares repurchased. Shares repurchased will be adjusted with treasury stock. There is one more concept called as liquidating dividend. Okay, that will also be reduced from additional paid-in capital. This will also I will discuss separately. Now let me explain about preferred stock. If you differentiate preferred stock and common stock, then that will have a better understanding. I request you to have a notes on this also. Okay, so there is a limited discussion and the material that is with you. So I request you to have a differential classification and have a better understanding of these particular preferred stock and common stock. Number one, voting rights. No. Yes. Voting rights are not given for preferred stock and it is given for common stock. Dividend is normally paid at a fixed rate. For example, we say 12% preferred stock, 8% preferred stock, like that we use the word. So normally the dividend is paid at a fixed rate for preferred stock. For common stock, no such fixed dividend is paid. No such fixed dividend is paid. It depends on the board of directors recommendation and the decision to pay. Okay. Okay, whenever you are paying dividend to common stockholders, then you should pay the dividend to preferred stockholders also. For example, a company is paying dividend to common stockholders. Can you pay it without paying to preference shareholders? Can you pay it without paying to preference shareholders? No. So without paying to preference shareholders, you cannot pay for common stock. That is priority in dividend. Repayment of capital at the time of winding up. Winding up means dissolution. First preferred stockholders will be paid, next common stockholders will be paid. So this is a legal point of view, okay, or in management of affairs point of view. If you look at market value, okay, normally it will be around the face value, around the par value. Okay, common stock depends on the company's performance. Okay, and if you look at the risk parameters, okay, lesser risk, higher risk, because preferred shareholders or preferred stockholders will get the dividend at a fixed rate and will get back the capital at the time of winding up the company. So it is having a lesser risk, but whereas common stock will have a higher risk, because only after paying the preferred stock, then you can pay to the common stock. That is returning of capital. And if you look at voting rates, already we discussed, preferred stakeholders or shareholders do not have voting right. Common stockholders are having the voting right. Participation in management, normally preferred shareholders do not enjoy. Only common stockholders enjoy the privilege of becoming a director, all those things. Then, see, sir, yes, sir, legal point of view, I understand so many things. But what is it? What is it actually? Really, what is the meaning of preferred stock? Really, what is the meaning of preferred stock? Let me give you a small example. Let's assume you are A and I am B. We would like to start a company. You are A and B, we would like to start a company. You are having $10 million with you, and let us assume I am having $5 million with me. So we formed a capital of $15 million. This is a newly started company. It's a newly started company. But for the company to have a startup and run, we want about 22 million. Okay, so can we go to a bank and apply for a loan of balance 7 million? Remember, it is a newly started company. We are ready to start our operations. Is it possible to apply loan for a newly started company? Very difficult to get a loan. Practically very difficult to get a loan when you are starting a new business. Existing business, depending upon your performance and other things, you can get it. And we can give our personal assets to, get the loan. But that is not safe because we are starting a company. Giving the personal assets for a corporate loan is not that much great idea. Or let us assume we do not have any other personal assets. Already we sold assets and got this 10 million and 5 million to invest in the company. We don't have any personal assets. So going for a loan or issuing a debenture or going for a bond in the initial stage may not be possible. So what happens is, okay, we approach our friends and relatives. To contribute, we say that we are investing 15 million. You please contribute. It may be our uncle, aunt, relatives, friends who are ready to help. It's not like they won't pick the call when there is a need for you. Okay, they rarely pick the call when there is a need for you. So your uncle and aunt, they look at your business, they look into your proposal, they look into your project, feasibility. So many questions they will ask. And it may be your grandfather or parents, or it can be even your very close relatives. Okay, so from the relatives, we are not borrowing money, we are getting 7 million. While getting this particular money, we will promise them that we will pay 10% every year. When there is a profit, we will pay 10% every year. Okay, before we take our capital, we will repay your capital, or we will repay your capital within 5 years, like that. Okay, we will promise. So these relatives are called as preferred stockholders. Okay, these relatives are called as preferred stockholders. Okay, So they are investing not by looking at the net assets of the company, they look at the equity shareholders, the quality of equity shareholders, the quality of their the earnings, quality of their management, so many factors they look into and give this. That's what. So preferred stockholders, okay, are like our uncle and aunt, are like our uncle and aunt. Will you give them to decide for your business? Yeah, happy that they gave the money, but will you allow them to decide for your business? No. Will you give them a dividend at a fixed rate? Yes. Yeah, before you take money, you have to pay your uncle and aunt. Okay, without paying them, if you buy a car, if you buy a luxury thing, and if you take the profit and enjoy, they will curse you, or they will throw the stones at you. Okay, so before you take back your capital, it is your responsibility that you return the capital of your uncle and aunt. Okay, see, since they are not owners, the market value will be around the par value. Okay, they are not taking any risk because they will definitely get back the capital. They will not participate in the management. See, your uncle and aunt has given the money, or friends and relatives have given the money. Will you allow them to take family decisions? Okay, will you allow them to take decisions within the family? Certainly not, certainly not. So they are kind of a preference shareholders. So they don't have voting right. They will get a dividend at fixed rate. They will get the first priority in getting the dividend. They will get back the capital at the time of winding of the company. Market value will be around the par value. They take lesser risk. Participation in the management, no. Okay. Now, there are different types of preference shares. Please note this also. One is called redeemable. Okay. Another one is irredeemable. Simple. See, if it is promised that the money will be returned after 5 years, you will return it after 5 years. Okay. Irredeemable means they are not repaid till the winding up of the company. Winding up means closure of the company. So redeemable preference shares are repaid at the end of the specified period. Irredeemable preference shares are not repaid till the company is wound up. This is one. Then the shares can be convertible. This can be convertible or non-convertible. Convertible means convertible into equity shares. That is common stock. Okay. Option to convert is given to common stock at the end of some period. If you want, you can convert them at the market rate. This is about types of preferred stock. Okay. Then most important type is cumulative preferred stock, non-cumulative preferred stock. Cumulative means dividend will get accumulated. Okay, let us understand the cumulative and non-cumulative preference shares in a better way. Okay, so what is a cumulative preference share? Okay, through an example, let me to make it understand. Let's assume 2016 onwards, a company's results are given. These are the past 4 years results. I request you to copy this also. So this is the status of financial results, and the company is having a common stock. That's nothing but ordinary shares to the extent of $30 million. Preferred stock. Okay, 9% preferred stock. to the extent of dollar 20 million. Now, okay, 2016, 17, 18, 19, there was a loss. In 2020, there is a profit. Okay, dividend will be declared in the year in which the company makes a profit. Otherwise, it will be like a liquidating dividend, which I will discuss it later. Okay, so for the past 4 years, okay, 2016, 17, 18, 19, the company was in loss, so it did not pay any dividend, both to common stock as well as preferred stock. Now, let's assume it's a non-cumulative preferred stock. If it is a non-cumulative preferred stock, in 2020, if the company pays 12% dividend to equity shares, that is common stock, what will happen? Simple. Before paying the dividend to common stock, you have to pay the dividend for preferred stock. Okay, so first you have to pay the dividend on preferred stock, which will be 20 million into 9% you have to pay. Then on common stock, 30 million into 12% they are declaring. So this is what they have to pay. If it is a non-cumulative preferred stock, okay, dividend is payable if there is a profit. If there is a profit, if the dividend is paid to common stockholders, then is payable to preferred stockholders. So only when the dividend is paid to common stockholders, then dividend is payable to preferred shareholders if there is a profit. Okay. In 2020, if the company pays no dividend, common stock, then no dividend is payable to preferred stock also. Okay, so in 2020, if the company pays 12% dividend to common stockholders, then first pay the dividend to preferred stock, then for common stockholders you pay the dividend. If the company is not paying any dividend to common stockholders, then no dividend is payable to preferred stockholders also. So non-cumulative means dividend will be paid only for that year. Sir, what about the arrears which are there for 4 years due to losses? Nothing will be paid. It is called as a non-cumulative preferred stock. Okay. So same example, let me take and continue. I hope you copied this. If not, pass and copy. Most important point to notice, if it is a non-cumulative preferred stock in the year of profit, if the dividend is paid to common stock, then dividend is payable to preferred stock. Okay. Next, if it is a cumulative preferred stock, if it is a cumulative preferred stock, same. If the company pays 12% dividend to common stock, then what will happen is, for preferred stock what to do? For preferred shareholders, preference shareholders what to do? What is the preference shares? 20 million into 9% into, you will pay dividend for 2016, 2017, 2018, 2019, 4 plus 1, 5 years. So 9 million of dividend has to be paid for preferred stockholders. Then on common stock, how much? 30 million into 12%. This much you have to pay. So if you look at the dividend payout total, it comes to 12.6 million. It comes to 12.6 million. Now if you look at profits available is only 12 million, but we are paying 12.6 million, which means the 0.6 million would have been paid out of additional paid in capital. Otherwise, dividend paid out of EPIC is known as liquidating dividend. You are paying out of the capital profit. So dividend paid out of additional paid in capital is called as liquidating dividend. Okay, so if it is a cumulative preference share, in 2020, if the company pays 12% dividend to common stockholders, then you have to pay the dividend to preferred stockholders also. For how many years? For the past 4 years plus current years. 5 years dividend you have got to pay. Then you pay the dividend to common stockholders. So this is a difference between cumulative stock and non-cumulative stock. So if preferred shares are cumulative, then when there is a profit, if the company pays dividend to common stock, then dividend to preferred stock also becomes payable for current year and also for past years. Within bracket arrears. If there is any past year arrears that you have to settle. So this is about cumulative preferred stock. And if no dividend is paid in 2020, then here also no dividend to preferred stock. So the obligation to pay preference dividend comes only when there is a dividend that is paid to common stockholders. One more example. The company is in profit. And the company is having preferred stock 8%, 50 million, common stock 40 million. Okay. Let's assume it's a cumulative preference shares. 2018 and 19, no dividend to CS was paid, which means for 2018 and 19, no dividend to preferred shares also, preferred stock also. Okay, next. In 2020, the company declared 9% dividend to common stock. Then what will happen? So in 2020, dividend to preference shares will be in 2020 only. 2018-19 nothing would be paid. In 2020 the dividend to preference shares will be 50 million into 8% for how many years? 3 years you have to pay. Then dividend to common stockholders will be 40 million into 9% you have to pay. So this is the total dividend obligation. This is the total dividend obligation. Hope you understand, right? So if it is a cumulative preference share, dividend is payable only when the dividend is paid to common stockholders. But you have to pay for the current year plus arrears. Current year 2020 plus arrears also you have to pay when the dividend is paid to common stockholders. So this is the most important difference between ordinary shares and preferred stock. Then what is the difference between preferred stock and debentures? Okay. Source. Both are long-term sources. It's a similarity. Okay. Obligation to pay interest is compulsory, irrespective of profit or loss, but dividend is payable only when there is a profit, and if dividend is paid to common stock. This is about obligation to pay. Tax. Cannot be claimed as an expense, which means it is paid out of profit after tax. The interest, it is known as finance charges. Okay, claimed or deductible as expense for tax purposes. Type of source. Still this is called as shareholders funds, or it is part of net worth. This is part of borrowed funds, otherwise called as debts. So this is a difference between a preference share and a debenture or bond. I request you to please pause this and note this. Okay, hope you copied this. Coming back to the material, we had seen the face value. Okay, if there is a journal entry, we'll pass entry like cash account at R2, the common stock or preferred stock, whatever is issued, to additional paid in capital. Okay, dividends, we had seen when the dividend is payable. Okay, or how the dividend is payable. We will see the different types of dividend now. Okay, cash dividend means it is payable in cash. It is payable in cash. Okay, when the dividend is declared, okay, for example, board of directors will declare the dividend. Simple, it becomes a dividend payable. It becomes a dividend payable. Okay, what is the journal entry you will pass? Retained earnings account at R2 dividend payable account. Retained earnings is nothing but P&L account balance to dividend payable account. So what is the implication? What is the implication in the balance sheet? Okay, retained earnings are part of reserves and surplus, or you can call it as net worth. Okay, dividend payable is a current liability. If you look at, net worth will decrease, okay, and current liability increases. So impact on declaring the dividend is net worth will decrease and current liability will increase. When current liability increases, working capital, reduces. Otherwise, you have to use that money for paying the dividend. The capital that is blocked for day-to-day operations, short-term requirements, working capital will reduce. Okay, so that is the implication. It reduces the obligation. Date of record is the date on which, for example, let us assume for the financial year 2020, Board of Directors declare a dividend of 15% on, let's assume, 10th April 2021. Sir, why in 10th April 2021? Because financial year results will be available only after auditing, probably in January month or February month. The Board of Directors declares a dividend on 10th April 2021. Okay, they will use a word. This is called as declaration date. Record date. Record date means, okay, let's assume record date is given as 20th April 2021, which means whoever is the shareholder on 20th April 2021 will get the dividend. Okay. Let me to take 4 shareholders. Shareholders A, B, C, D. Okay. Date of sale. They were shareholders in the company for the past 3 or 4 years. They are selling the shares. He sold the shares on 10th April. B sold the shares on 19th April. He sold the shares on 25th April. D sold the share on 1st May. What about dividend? Yes, you will get. Yes, you will get. It is sold after the record date. It is sold after the record date. So think over an answer. If you look at A sold the shares on 10th April itself, which means on 20th April you should have been a shareholder. Are you a shareholder? No. So no dividend. 19th April also, you sold the share before the record date, which means on 20th April 2021 you were not a shareholder. No dividend. C is selling the share only on 25th April, which means he was a shareholder on 20th April. Yes, he will get the dividend. Yes, he will get the dividend. Because C and D were shareholders on the record date. So record date is nothing but data updating or taking the record, okay, for the people who are available on the date, the dividend will be paid. What will be people available on the date? As per the membership register. Okay, as per the membership register, if your name is appearing as a shareholder, so number of shares sold into face value into the dividend that will be paid to you. If you are selling the shares after the record date, then no dividend is payable for you. Sorry, if you are selling the shares after the record date, dividend you will get. If you sell the shares before the record date, then you will not get the dividend. But if you look at A and B were holding the shares for the financial year 2020. They were holding the shares for financial year 2020. But they sold the shares before 20th April. On 20th April, they were not shareholders, so no dividend is payable to them. So record date is nothing but, okay, who will receive the dividend? Okay, anyone who owns a share on the date of record will be getting the dividend, dividend. Okay, so when dividend is paid, dividend payable account data to cash. When dividend is paid, if you look at when dividend is created, what is journal entry we pass? Retained earnings account data or to dividend payable account. If dividend is paid, what is journal entry we pass? dividend payable account debt are where current liability decreases to cash. Current asset also decreases. So it will not change working capital. Okay. So on the date of declaration of dividend, working capital will reduce. Because you are transferring to a current liability. Okay, on the date of payment of dividend, it will not change the working capital. Cash balance will go down. Simultaneously, a current liability also will go down. So it will not change the working capital. Please note this, it can be an examination area. Okay, so this is about dividends. Then this I already explained it to you. Liquidating dividends are nothing but when dividend is paid out of capital, then that is called as liquidating dividend. Okay, for example, we had seen an example where here 12.6 million is the dividend payable, but profits available is 12 million. Okay, then that 0.6 million is out of EPIC, additional paid-in capital. Okay, then you may ask, sir, the company is having loss for the past 4 years. This year there is a profit of 12 million. I assume that sufficient reserves and surplus are available. Okay, let us assume retained earnings of the company, I think, but reserves and surplus is 4 million. Okay, additional paid-in capital is 10 million. EPIC is 10 million. Okay, dividend paid is 9 million. So in this case, we are using 4 million of retained earnings and 6 of balance, 9, 5 minus 4, 5 million of EPIC we are using. To the extent EPIC is used, okay, that is called as liquidating dividend. So journal entry will be retained earnings account data. In this example, it will be like 4 million. Additional paid-in capital, that 5 million difference. We have got 10 million, but we are going to use only 5 million to cash. Okay. Property dividends are nothing but distribution of assets other than cash. Distribution of assets other than cash. Just go through the example, you will understand. In India it is not possible, but in US it is possible. See, to the shareholders, instead of giving dividend, you can give assets. It can be investment in another company, all those things. 1 million market, or 1 million is the value. Market value on the date of declaration of dividend was 12.5 million. They are declaring the dividend. So first you record the gain. Okay, there is a gain of 2.5 lakhs. So 2,50,000 of gain first recorded. Then retained earnings account data to dividend payable account. Then dividend payable account data to investment account. Dividend payable account data to investment account. Earlier it was dividend payable account data to cash. Now it is dividend payable account data to investment. That's the only difference. And second difference is, see, we have invested only 1 million, but when you pay the dividend, the market values, or when you declare the dividend, the market value is 2.5 million extra. Sorry, 0.25 million extra. So record the gain, transfer retained earnings to dividend payable, then give the property as dividend. Okay. For the shareholders point of view, debit what comes in, asset account data to dividend income account. Everything will be recorded at fair value. Go through this. Thousand shares of 75, market value is 100. Market value is 100. The amount charged as retained earnings to retained earnings as a result of declaration of dividend will be, what is a fair value? 1000 into 100. 1000 into 100, that is the fair value of asset that you are giving up for the dividend. So 1 lakh will be charged. 1 lakh will be charged to retained earnings. Look at this. So what should be the value at which the dividend should be recorded? Read the question. On December 1st, they declare a property dividend. They declared a property dividend. On the date of declaration, what is the market value? On December 1st, 1,50,000. So while passing the journal entry, retained earnings account date or to property dividends, okay, they will be recording how much? 1,50,000. Okay, on the date of payment, the actual amount may be different. At the end of the year, the amount may be different, but on the date of declaration, whatever is the fair market value, that is the value they would have recorded. Okay, stock dividend is nothing but instead of giving the dividend in cash, you give company's own shares. For example, we have to give 9 million of dividend. Instead of paying the dividend in cash, you allot the shares itself. It can be a common stock or equity stock as agreed upon, you just allot the shares itself. That is called as a stock dividend. Stock dividend will not change the working capital, or whether working capital will change. On the date of declaration of dividend, the working capital will reduce. On the date of declaration of dividend, working capital will reduce. Same effect, because we are going to pass journal entry, retained earnings account data to dividend payable account. So, okay, dividend payable account data to common stock or preferred stock we are going to record. Okay, because of that, no change in current asset takes place. So, it will increase the working capital. On the date of declaration of dividend, it will reduce the working capital, and on the date of payment of dividend, it will go up. Okay, so this dividend can be a small stock dividend or it can be a higher stock dividend. Go to this. Dividend amount will be 7% on 10,000 into 3. The working will be 7% into 10,000 into 3. Dividend is always calculated on the par value. Dividend is always calculated on the par value. 10,000 into 3, 30,000 into 7%, 2,100 is the answer. See, dividend is always based on the par value of the stock, face value of the stock. So 10,000 into 3, 30,000 into 7%. Fair value doesn't matter for declaring dividend. As far as company is concerned, dividend is always calculated on the paid up value or par value. Go to this. This is part of your cash flow statement problem. They had a balance of 1 lakh at the beginning of the year, 1,25,000 at the end of the year. Net income means net profit for the period is 40,000. Okay, they have given dividend payable has decreased by 5,000 throughout the year. The amount of stock dividend is 8,000. Okay, what should be the cash dividend? What is the cash dividend? think over an answer. If you look at what is the net income for the year, 40,000. Net income for the year is 40,000. In this, what is the stock? Okay. In this, what is the change in retained earnings? Opening balance to closing balance. There is an increase of retained earnings. Retained earnings has increased by 25,000. So net income is 40,000. Retained earnings is 25,000, which means the income should have been there as retained earnings. Okay. See, it should have been 40,000 increase, but increase is only 25,000, which means dividend declared should have been 15,000. See, opening balance of retained earnings plus net income should give us closing balance. Okay, if opening balance is somewhere about 1 lakh, okay, net income is 40,000, should have been 1,40,000, but the actual balance is only 1,25,000, which means the company has declared a dividend of $15,000. In this, stock dividends are 8,000. Which means cash dividend would have been 7,000. Apart from that, reduction in dividend payable, which means we have paid this dividend $5,000. So we would have paid totally $7,000 plus $5,000. We would have paid totally $12,000. So this year, current year dividend declared is 7,000. Apart from that, from last year to current year, outstanding amount of dividend that has reduced means it has paid. So 12,000 we would have paid. We would have paid 12,000 total dividend. Stock splits are nothing but splitting the fair value of the stock. For example, let us assume company is having a common stock to the extent of 2 lakhs, having a fair value of or face value of 2, which means $4 lakhs is the paid up capital. This can be split up. Suppose if the split is like 1:2 or 2:1, 2:1, which means 2 share will be given for every 1 share held. So simple, the total value will remain the same. $4 lakh will remain the same. Only thing is that number of shares will change. Instead of 2 lakhs, it's going to be 4 lakh shares. If you look at the par value, it's going to be 4 lakh value divided by 4 lakh shares. So 1. Simple, the par value is getting reduced. If you look at old par value was 2, the par value becomes 1. So it will not change the total paid up capital. It will just change the number of shares. It will just change the number of shares and par value gets adjusted accordingly. So it will not change the working capital. It will not come in cash flow. It will just change the face value of share. That's all. You can go through that. Memo entry means a dummy entry will be passed. Okay, you will pass entry like old capital you will debit and cancel and new capital you will bring in. This is called as a stock split. We know the meaning of retained earnings. Okay, net income after tax. So this balance will get reduced when you declare the dividend. Treasury stock is nothing but repurchase, shares bought back. Shares bought back is otherwise called as a treasury stock. For example, Let us take this example. Let's assume the company is having 4 lakh shares of $1 value, totally $4 lakh value. The company finds an excess money, or the company finds slowdown in business. The company is not finding out new investment opportunities. Now what the company can do is, they can buy the share and cancel them. They can buy the share and cancel them, or they can keep it. That is called as a treasury stock. So treasury stock is nothing but shares repurchased. Shares which are repurchased. Okay. What are the different types of shares? Authorized share is nothing but the maximum number of shares which can be issued. At the time of registration of company, let us assume you've registered a company with 1 lakh shares of $10 each. So which means 10 lakhs. Otherwise 1 million is the authorized capital. Otherwise this is the maximum capital which you can raise. That's called as authorized shares. Okay. So this only authorized shares, your financials are not affected. Balance sheet is not affected because of this. Okay. So it will not affect stock dividend or stock split or treasury share transactions. Issued share is nothing but shares which are issued to the public. See, out of this 1 lakh, let's assume 40,000 shares at the rate of 10, which means 4 lakhs is the issued share capital. 4 lakhs is the issued share capital. Okay. So this is also not affected by treasury share transaction. Okay. It will change when there is a stock split and stock dividend. Okay. Treasury stock means buying back the share. Buying back the share will not affect the issued shares. Okay. Outstanding share is nothing but, okay, this one less shares bought back. That is also called as treasury stock. Let's assume we bought back about 5,000 stock. And the face value, of course, 10, it will be reduced. 50,000 will be reduced. We will take 3,50,000. This is the net paid up capital. This is the net paid up capital. So authorized capital is not affected by stock splits or stock dividend or treasury transactions. Okay. Issued capital, yes, when you split the stock, the number of shares will change. When you give the stock dividend, nothing but instead of paying the dividend in cash, when you give the shares, it will change. Okay. Okay. When there's a stock split, automatically whenever there is a change in issued capital, outstanding shares will change. Whenever you declare stock dividend, automatically whenever the issued shares change, number of shares outstanding also will change. Treasury stock is nothing but shares which are repurchased will be reduced from the total stock. Okay. To sum up whatever we have learned, common stock, what to do? Issued shares less treasury stock, that is nothing but shares repurchased. It will be shown in the balance sheet. Then preferred stock will be shown in the balance sheet. Then retained earnings will be shown in the balance sheet. Then you will record APIC, additional paid in capital, in the balance sheet. Of course, the shares which are repurchased will be reduced. Okay, so this will give us the final statement of equity. This has to be updated or prepared every year. So in this we had seen different types of dividend, we had seen different types of preferred stock. Okay, we had seen various aspects. Okay, so in the next session I will be covering accounting for taxes and accounting for leases separately or together depending upon the length of the class. I will cover up. accounting for taxes and accounting for leases. One of the most important area for examination is going to be the next session. Have a great day.